Welcome to the Moss Adams webcast series on tax reform. Today we're going to talk about the major business incentives that companies use and whether they were impacted by the tax reform bill. With me today is Irina Antonache. She's a senior manager in the tax specialty group. I'm Rob O'Neill. I'm a partner in the tax specialty group. The incentives that we're going to cover as part of this presentation include the Historic Tax Credit Program, Work Opportunity Tax Credit Program, the Major Energy Incentives, Low-Income Housing Tax Credit Program, and the New Market Tax Credits Program. There was a lot on the table for Congress to consider as part of H.R. 1, and ultimately, in the end, not a lot happened as it relates to credits and incentives. Several programs were originally scheduled for repeal or defunding, but ultimately, in the end, most of the business community will be largely unimpacted by tax reform, at least as it relates to credits and incentives. That's definitely not the case for other provisions of the bill not covered by this presentation.
One program that was specifically impacted by H.R. 1 is the Historic Tax Credit under IRC 47. As some of you may know, the credit offered a 10% income tax credit for non-certified buildings and a 20% income tax credit for certified buildings on the National Registry. Section 13402 has removed the 10% credit for non-certified buildings and makes the credit a 5-year credit as opposed to a 1-year credit.
One program that was threatened for repeal but ultimately retained was the Work Opportunity Tax Credit that's offered under IRC Section 51. This is a very widely used hiring incentive that provides between $2,400 and $9,600 for hiring individuals with barriers to employment. The credit is scheduled to sunset now 12/31/19 and was unimpacted by the tax reform bill. Another program that was also not affected by the tax reform bill was the Low-Income Housing Tax Credit Program offered under IRC Section 42. This program is very popular and was really never threatened by the tax reform bill and provides a federal income tax credit of 4 or 9% to be claimed over 10 years for low-income housing development.
Energy credits under IRC 45 and 48 were considered for repeal but were ultimately retained. As such, no changes were made. Both sections retained the existing phase-out provisions for big wind and solar projects and retained sunset provisions for small wind, combined heat and power, and other types of projects. The New Market Tax Credit under Section 45 was another program where Congress initially tried to defund the program by $3.5 billion, but ultimately decided to retain the credit. It is currently set to sunset 12/31/19. The credit offers a 39% federal income tax credit to be claimed over 7 years, 5% for the first 3 years, and 6% for the following 3 years. The credit is earned for making investments in a qualified development entity that also makes investments in low-income communities and qualified projects. To cover more detail of the historic tax credit legislation, as I previously mentioned, the legislation had a 10% credit for historic structures pre-1936, not on the National Registry, and a 20% credit for historic structures that were certified on the National Register. This was a 1-year credit based on the year the project was placed in service and had a 5-year recapture period. H.R. 1 removed the 10% credit and only retained the 20% credit for historic structures that are certified and on the National Register. The credit is now also claimed over 5 years as opposed to 1 year based on the year the project is placed in service. The 5-year recapture period is retained.
The 5-year recapture period is unchanged, but the use of the credit over 5 years is a big change that will affect the price tax equity investors are willing to pay for the purchase of a developer's historic tax credit. The current market for historic tax credit equity is in the low 90s. As a result of the credit now being used over a 5-year period, expect pricing to fall to the upper 70s or low 80s and ultimately result in less money in the developer's pockets for the sale of their historic tax credits.
Congress did offer some transition rules for taxpayers that currently own or lease buildings that are qualified for the credit. As such, if a taxpayer owns a building anytime on or after January 1, 2018, the taxpayer has 180 days from the enactment of the new legislation to begin their 24-month rehabilitation period or 60-month period if a phased project to be grandfathered under the old rules of the program. Accordingly, a developer can make qualified expenditures for such buildings before December 31, 2020 or December 31, 2023 if a phased approach, and could still be eligible for the historic credits under the old legislation. The new legislation would be applicable to expenditures made after the end of the taxable year in which the 24-month or 60-month period ends. As such, developers should be mindful of where they fall under the legislation to make sure that they can properly account for the type of financing they're going to get and the type of investment they will make and investors will make in their projects as far as financing.
This concludes our presentation on the major impacts of tax reform on credits and incentives as it relates to business. If you'd like to contact myself or Irina, our contact information is on the slide. Thank you for your time.